General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
Alright, cool. So it's the middle of the month. If higher time frame delivery change, reframe the narrative and the framework. So I'm actually thinking this is going to be the low for the whole month. We opened up here, week 1, push down, week 2, smart money reversal, closed above this low, previous week's low, and closed at previous week's EQ. I think the lower the month is in and we head for higher prices. Adjust the weekly bias template. On bullish, institutions seem to have stepped aside short term for the summer, so we are being non-directional. Note the shifts in the framework hit rate. It's been a lot of chop days, but it's summer. Ping pong is expected. Add 2 case studies. I don't have any case studies. Time frame context review. Did the month deliver bias I said at the monthly open? Started off the month bias bullish, and no, we are under June open price. But I think anchor for the month is in. I think we finish above June open price. Yeah. When did the high and low print? So we're on week 3 now. This is week 1 here. Started the month. Nice reaction here. Sold off. Kind of feel like week 1 was just engineering liquidity, especially since we didn't take this low. We just wicked it. So we created those relative equal lows. Week 2 we delivered. This is a higher time frame order block we bounced off of. Created a new order block that we can use for higher prices. Week 1 was an inside week. It is true. So week 1, we didn't take previous week's high or low. Accumulation created the relative equal lows that got swept for week 2. This is the candidate for the low of the month. I don't know if it's the low of the month to the month's over with. Only 2 more weeks left. Which weekly expansions actually built the monthly candle? What did price mitigate? Previous OB, BPR, fair value gap on the monthly or the weekly. So the weekly time frame, we've been in accumulation. This week 1 and this week 2, it didn't do anything. Basically been an inside week. And people seeing a bull bear market while we're doing that. Lord. Alright. Both of these weeks look terrible. No expansions were built using these weekly candles. Decision quality. The percentage of high probability versus low probability taken this month. One or two lines on whether you treated them correctly. Should I let them run or versus let them pay sooner? I gotta start playing more PM session when there's room left in the ADR. Institutions are playing the game when it comes to filling the orders. So one thing I've been noticing is the AM chop. You might have to just skip it, come in the PM session to get the move that you're planning for. Or it might come in Asia. So it's not like New York is giving the best opportunity. And London has been trash. They've been killing London people. Narrative framework versus accuracy. Forecast at monthly open versus well printed. Two wild bullets. What you read right or wrong. I've been a lot more accurate when I focus on getting the main idea right, not every single swing high and low. I find If I find a high time frame key level hit on a Tuesday or Wednesday, that could be the anchor for the week that plays the weekly candle out. So that approach has been a lot better. Instead of every single day, like this is the high and low today, just wait for that weekly anchor to print. It makes the rest of the week a lot easier. Experience success/failure. Experience month, cost of business month. Was it an off model month plus the side behavior that defined it? So this is a 1+ experience month. Getting used to following my own process of peaceful trading. The single behavior that defines it is not picking a high and low today, and base hits and break evens. Case study vault, no case study, screenshots. It's just the weekly. So we had this weekly volume imbalance. We gave it sell side and buy side. Weekly volume imbalance just now. But this is the sell side, but we're having trouble filling it with the body. So it makes sense to look for this to get filled. Daily, same volume balance, same range inside of a range. E3, SK Hynix, South Korea memory chip giant to list on Wall Street. It's not in the NASDAQ. It's just, I think they call them ADR shares where you can buy it, but it's not in the ETF. It's not going to get passive flows. It's not going to mess with the rating of the NASDAQ. NASDAQ composite jumps. Tech stocks power rally. I don't know if I really believe that. Micron stock shakes off selling pressure, close up 1%. SanDisk even better. That makes sense. This week is CPI on Tuesday. It's the main event. Marsh has a 2-day thing. It's going to be interesting to watch him. There'll be lots of notes to see how if he has the same poise as Powell. PPI is going to probably be more important than PPI or than CPI. It's going to give a look into future inflation. Retail sales, fully fed, manufacturing, unemployment. I want to see how Wash handles this stuff because I don't think he likes the surveys like the manufacturing index. Consumer sentiment, I know he don't probably like that either. He don't like surveys. CPI is basically a survey. And look at the COT. Non-commercials look like they're short. Commercials look like they're short. they're taking profits on longs over here, and they're taking profits on shorts over here, and they're adding to longs. Okay, that's interesting. Get off of this. There it goes. All right, current cop buys cautiously bullish setup. Not yet a confirmed bullish trade. Commercials remain net short, but their 20,000 contract bullish weekly shift is the key signal. Large specs are becoming more bearish, while small traders remain strongly long. That combination suggests watching for a downside failure followed by upside reversal rather than buying immediately into strength. So we bullish over here. At NASDAQ, these guys are closing out their shorts, and these guys are taking profits on their long. It's like the opposite. They closing out their longs, these guys closing out their shorts. This is moderately bearish. Commercials made the most important move, swinging sharply from net long to net short. Small traders became more bullish, which is contrarian negative. Large speculators remain net short, preventing this from being a fully aligned extreme bullish setup. The practical expectation is near-term consolidation or distribution with elevated downside break risk rather than immediate forecast of a major collapse. And this is a dashboard I just had put together with the non-commercial positioning for 13 weeks. I've been watching White Oak do his thing. I've been pretty accurate looking at the non-commercials and the 13-week averages, so I'm studying that as well. And see, we got strong SPY bullish, but only 42% for NASDAQ. So SPY's gonna be the thing I'm looking at. Gold is bullish, COT wise, but it's not bullish on the price. So I'm interested in that. Oil is pretty bearish. That's gonna be probably easy sales. And the dollar's bullish, everything else is bearish. The British pound and the yen kind of got some strength. That's it. I'm gonna just update that every week, and the Excel makes it super easy. I just add the new numbers and boom, the dashboard to populate. I can keep studying in action, like forward testing / studying. It's the Fed watch. We gotta watch this because we're pricing in hikes. So Tuesday when they come out with inflation, come back and check and see if the hikes is going up. So that's gonna be a sign that the price can be bearish. But if the hikes go down, maybe ease coming in, maybe they start pricing in rate cuts. The market is forward looking and they start going bullish off of that alone. So NASDAQ is weak for sales, and we got hikes in. Let's say CPI comes in to where we feel like we have to hike rates, then NASDAQ will be the best sell. But if CPI comes in to where things look more bullish, then the SPY will be the best buy for the whole rest of the week. And you'll know that on Tuesday. And the earnings, ASML, and then we got the banks. So Tuesday is important for the SPY because it has financials, JP Morgan, and then Wednesday is important for NASDAQ because ASML. Then we got TSM, UNH, that's a big dog. Netflix, it's not top 20 no more, but it's still, Netflix used to move the market by itself. You know, times change. But big earnings almost every day this week, and options expire. So big levels should be hit. It's still summer though. So here, earnings season kicked off with ASML being NASDAQ first top 20 to report. And Tuesday is it Tuesday? Yep, Tuesday is big for SPX with JPN being the first out of these top 20. No SpaceX over here. Sentiment is neutral. Still a little bit more bearish, but basically neutral. The NASDAQ, I'm thinking this is lower than month. Lots of liquidity here. This is the reaction off of the bearish order block that gave us the down push. I like this cleaning up this week. So this is a protected low. Just looking for higher prices. This is the remainder of that volume imbalance that we need to fill. And July open price because I'm bullish for this month. Let's see, price expand above. No notes. I think low the month is in. So far in July, the NASDAQ has remained supported by the strength of AI, semiconductors, and the memory sector. Although some rotation out of the largest technology names has created uneven price action, the index remains bullish overall. But midterm year uncertainty and Trump-Iran tensions could produce sharper volatility if oil and inflation expectations begin to rise. Engaging. The SPY stronger for the buy. We cleared out the liquidity from the order block. This is our new anchor, and this is what I'm thinking lower this month would be. Alright. SPY has shown broader market strength than the NASDAQ because it benefits from rotation into financials, industrials, energy, and other sectors outside of technology. This wider participation makes the S&P look more balanced, but geopolitical risks surrounding Trump and Iran could still pressure the index if investors move towards defensive assets. Okay, that makes sense. NVIDIA, I'm thinking this lower the month is in as well. We didn't even need to come here, but same two lows. NVIDIA remains one of the strongest drivers of both the NASDAQ and the SPY as demand for AI infrastructure continues to support the long-term trend. However, rotation into memory stocks and other semiconductor companies may temporarily reduce NVIDIA's leadership, while geopolitical headlines and midterm year volatility could create short-term pullbacks. We're still engaged in skill focus is peaceful trading, journal intent every day, no case studies. Thinking 1%, even though it's option expiry week, so I put it here. So we week, which is the aggressive, but I want to see us leave this balance area before I put on big risk because it's still summertime. We can snap right back, like push up and then just come right back. And we haven't for that to be like, okay, new all-time highs, good news, or even bad news. Plan strike day Tuesday, we got CPI. Okay. All right, that's all the work. Y'all have a good day. Peace.